Exiting a position at the right time and at the right profit is a skill which you need to develop, and it's a function of your setup. Exit, there is no universal exit, like there are no universal stop. Exit is a function of setup which you are trading. I trade a setup which is 3 to 5 day momentum burst. So inherently, because the setup itself is 3 to 5 days, my exits are 3 to 5 days. Or some people trade setups which have a trend component. If you are going to be trading a trend following kind of a method, inherently the setup itself, by name itself, it says trend following. So in that case, your exit will be when the trend has changed. And within that also, like there are a lot of variations which successful trend followers do. So exit is something which is where you can build a lot of edge by exiting it the right way. There are many ways you can exit, especially if you are a swing trader. One of the very, very popular or very common method by which successful swing traders exit position is by exiting into strength. Exiting into strength is basically where you are not waiting for the momentum to fade. Before the momentum starts fading, when the stock itself is going up and it is at a very high momentum, you start selling your position into strength. Selling into strength ensures that you capture maximum amount of profit. Sometimes when you sell into strength, the stock will continue to go up. But most of the professional traders I know of and who are highly successful, they sell into strength. If you don't sell into strength and if you just use stops, there is no guarantee that you will keep the profit, because if the stock after my entry in 20 days is up 20% and I don't sell part of the position, or I don't sell like say some 70-75% of the position, and next day morning, even though I might have stopped to protect my 20% profit, if the stock gaps down, my profit is gone. So this is why you will see professional trader prefer selling into strength. So they will, like, and I say I buy 3,000 shares, and then if the stock goes up 10%, I might sell 25%. If it goes up 15%, I sell another 25%. If it goes up 20%, I sell another 25%. And remaining 25%, I will put a stop, which will be willing to sacrifice say 5% of the profit out of 20% in the hope that I get more of it, or even sometimes willing to sacrifice only 2% of the profit. Now exits like these will improve your success ratio and profitability, because when you do this way, you are constantly selling into strength and you're not waiting for the position to come back. I was just 2 days ago, a trader approached me who has not been profitable, and he wanted me to have a look at his trading, and I was looking at his trades, and he did in January 26 trades, and out of the 26 trades he made profit only one trade where he closed the position at the right time. And I looked at and I discussed with him the remaining 25 trades. At some stage, those trades had profit between 10 to 15%, but he didn't take that profit when it was 10 to 15%, and he allowed the trade to come back and hit his stop. Now this is what is common amongst like people who don't have enough experience. By trial and error, if you remain in the market for many years, you realize that look, many times your position goes up 10, 15%, 20%, and then if you don't sell into strength, then it comes down, kind of a thing. And even if you study market, you will see that most of the breakouts, they only last for 20% kind of a move, 15 to 20%, and after that they either consolidate or they reverse. So if you have that understanding also, then you know if you get 15-20% kind of a profit, you're trying to sell into it if you're a swing trader. The other way of exiting is by using trailing stop. Now trailing stops are stops which keep on trailing the price. Like, so if the price was at 14 and you put a trailing stop of $1, the price goes to 16, your trailing stop will become 15. If it goes to 20, your trailing stop becomes 19. Now trailing stop is a very good way of exiting position. You are giving the position some room to run, but if it starts coming down, then you get stopped out. In a fast market, trailing stop can be very useful because many times the stock runs up a lot and you put in a trailing stop. That way, if it continues to move, your trailing stop will continue to move higher. If it starts going down, you can get out of it. So one way is to sell into strength. Second is trailing stop. Third way is not to sell your full position, but to sell partial positions. And this is again a common approach which is used by many traders, including me. I take a position and I sell 75%, 80%, and keep the 20% as a longer duration swing kind of a position. And this allows you to increase your success rate in terms of percentage of your trades working, and also allows you to benefit more from the same trading idea, because based on my study of breakouts, the kind of breakouts which I trade, they don't fail on the first day. They fail on second or third day. So if I know that breakouts are going to fail either on second or third day, and if I put in a position early in the morning and I put in a larger position and I take profit on 80% of the position, remaining 20% I play it as a swing, then what it does is it allows me to profit from this tendency of the market which I have studied. That is, like on the first day the stock tends to go up, and if it is going to fail, it fails on a second day or it fails on a third day. So that's another way of looking at it. The third way to exit is to exit using a time stop. That means if you are going to trade a position and you are going to hold for 3 days, so you enter and on third day you exit irrespective of whether it is profitable or not profitable. So time-based exits are also very common, and that also as a swing trading method works very well. Now, if you are going to be doing something like position trading, or if you are going to be doing something like trend following, then your exit strategy has to be a trend following kind of a strategy, because in trend following, most trend followers have a very low win rate in terms of percentage of their trades working. So most of the trend followers will operate on 25 to 30% success rate, or like 25 or 30% of their trades are going to work, and 70% of the time they're going to stop out. So because of the inherently the kind of setup they are trading, it's extremely important that on those 20 or 25% of the trades, you should allow the stock to go as high as possible, or you should not choke the trade, because these outlier trades are going to make your year, and they're going to compensate for 75% of the trades which didn't work. So in this case, trend following kind of stops are used. Trend followers typically use stops which are based on moving averages. So they might put a stop at a 10-day moving average or a 20-day moving average, and if the stock's trend turns and it comes and hits their stop, then they get stopped out. Now that is one way of doing it. If you are a more experienced trend following kind of a person, then you might want to use a different approach, which is like, if the trend speed increases, the velocity of the trend increases, then you decrease your moving average length, because if the trend starts moving very fast and it starts going parabolic, and if you keep your stop at 20-day moving average, what is going to happen is when it turns, you're going to lose a lot of money, because the turn is going to be a violent turn, because the velocity of the move was very high. So some of the very good trend traders, what they do is, if the velocity of the move starts increasing, they start decreasing their stops moving average. So they might start with a 20-day moving average as their stop. If the stock keeps going in their direction, they fast rapidly, then they'll drop it to 10-day moving average. If it really goes parabolic, they'll move it to a 5-day moving average. So that way, you are giving it a room, but at the same time, if it reverses, because when parabolic moves reverse, they reverse very fast, and you can end up, if you stop it at 20-day moving average, you're going to lose a lot of money. You're going to give up a lot of money. Now, the other kind of exit strategy, which is position traders, where they put a position, is structural stops. In structural stops, you start by putting in your stop at some level, move it to break even, the stock goes up, forms a consolidation, so you move your stop below the consolidation, then it goes up, and then it forms another consolidation, so you move your stop below that consolidation. So these are called structural stops, where you keep moving the stop based on what structure the stock forms. So if a stock goes up goes sideways for a long period of time, breaks out again, then you move your stop to the where you want the stop started going up, right? So this creativity in exit is important. If you just like and have a standard way of exiting, you might be leaving a lot of money on table. And also studying your setups and studying your own result will help you exit better. Basically, a lot of traders, they can enter into a position, but exit is a big issue for them. So think about the exit strategies. Like the best exit according to me for swing traders is exiting into strength. Partial exits, which is very commonly used approach by almost every profitable swing trader. Third is time based exit. So I trade a setup which is inherently 3 to 5 days. So after third day, I have take a call whether that setup has more potential. So I exit on a third day or a fourth day basically. And if unless there is a significant reason to keep it beyond that, I'm not going to keep it. Similarly, when you are looking at a lower time frame, if you're going to be day trading, you'll see that most of the moves in most of the stocks on an intraday basis, they just last for 15 to 20 minutes. So if you are trying to like hold it for longer than that time period, most of the time it is not going to work unless you get a stock which has a very strong trend and for the entire day it keeps going up. Uh, any other stop strategy doesn't work. So exit is important, and exit is one of the ways in which you can create an edge. So just don't think about exit as one common way of doing exiting and just using moving averages as an exit. Be creative, be innovative, play around, find out what other traders are doing, find out how successful traders like in a trade exit their position. And if you can do exit well, you do entry well, you'll make a lot of money.